Stock of the day, I thought we'd take a look at the ASX, the listed company behind the share trading platform. Had its AGM this morning. This chess movement of chess into a different platform. No update on that. It has been sort of going on for years and years. ASX telling shareholders that it's waiting on Accenture's independent review. New chief executive Helen Lofthouse told shareholders projects of this size and complexity are always challenging. This one certainly has. Shares in ASX are trading a bit higher today. Michael, what do you think of ASX?
Yeah, I mean it's been a very good performer over say a 5-year period. It is quite a conservative type business, but what we do like about it is a capital light business. So look, it's come back, a long way in recent times because there are basically 3 components that drive the earnings of ASX. There are the daily settlements, there are the primary market IPOs, which contribute about 20% of earnings, and then just general sort of volume. And we've obviously seen some of those areas come back a little bit in recent times, particularly the IPO market. But they are flagging a potential rise or about a 10 to 15% increase in their cost base. But I think a big part of ASX is the dividend yield. It is a consistent, steady dividend payer, pays out about 90% of a payout ratio. But the problem is as bond yields rally as strongly as they have, it just becomes a little bit less attractive to people at the margins. So strong business over the long term should do well as stock markets grow and do well and listings come on. But at the moment, I would just be steering clear.
Right.
Wouldn't put a sell. I just have to hold if you've been a long-term holder, but the trend does look pretty poor in the short term. So if you have a more short-term time frame, you could definitely sell it just because of that momentum looks pretty average.
Okay. Carl, what do you think of ASX?
Yeah, I agree. Momentum looks pretty average. Look, I mean, obviously volatility isn't bad for them. So, they don't care whether the market's going up or down. They're just clipping the ticket on the way through. But as Michael said, look, IPOs, 20% of their business, IPOs tend to slow down. So less companies tend to go to market when the market's terrible because the goal is to go to the market when the market's fantastic and you can flock your shares off it, at exorbitant prices. So, look, I think they're quite defensive though. Having said that, I think it's quite a defensive stock. I just don't think it's very cheap. I think that's the problem on the fundamental side. So trading about 27 times this year's earnings, about 6% compound annual growth rate over the next 3 or 4 years, which is pretty average as well. And the yield is okay, sort of 3.5%, but you're getting 3.5% in a bond now, in a 10-year bond. So it's hard to make a case for this one on the fundamentals. The chart, I think, reflects that as well. The chart is looking pretty shaky, as Michael said. It's coming back to the bottom of a range. If it cracks here, it could go quite a bit, actually. So I think 65s could be a possibility and maybe even 60s. And if the broader market goes, then that's not an unreasonable expectation. So if I can't find a reason to buy it on the fundamentals, on the valuation and the chart, if there's no reason to buy it, I have to go sell.